In this program, you learn how to determine when is the best time to turn on your Social Security benefits and how to maximize your benefits with various filing strategies. In addition to deciding when to turn on Social Security benefits, many people struggle with exactly when to retire. Often those dates do not coincide. Some believe they should retire now and wait until age 70 to file for Social Security because the check will be larger, while others want to file immediately for the cash flow and the uncertainty of Social Security's future. There is no perfect answer, but there is a logical answer for everyone based on their own circumstances. Your decision of when to retire and when to turn on your Social Security benefits should be based on many factors beyond the size of the check. Before you make the decision of when to retire, you need a financial plan for your lifestyle when you do retire, and that plan should include a strategy for where does Social Security fit in. In this presentation, you will learn how to make a sound decision on when and how to file for your Social Security benefits and learn strategies to maximize the benefits you will receive over your lifetime. Before we address the specifics of Social Security claiming strategies, we need to understand your profile. The answer to these questions will assist you when making a decision of when and how to file for your benefits. If you are in poor health and your job is exacerbating the matter, then you may want to consider retiring sooner rather than later, and possibly turning on your Social Security benefits sooner as well. If your family has a history of health issues, that may give you cause to file sooner also. However, if your health is good, you like your job, and you have longevity in your family, then you may choose to delay retirement and/or filing for your benefits until a later year. How about your finances? Retirement is not free. You still have to support your basic needs: housing, utilities, food, medical, insurance, taxes, etc. You must have a clear understanding of your cost of living and a plan to meet those needs. This worksheet, which is available on our website, serves as a guide to help you take inventory of your expenses. Consider every expense you have without exception. The more accurate the worksheet, the more valuable it will be in planning your future. We begin with your home. Do you rent or own? Do you have a mortgage? What are your property taxes? Homeowners insurance? When you pay off your mortgage, your property taxes and insurance will continue indefinitely. Do you have any short-term debts? List your short-term debts and obligations and what your monthly payments are and when the debt will be retired. Next, we look at household expenses. From your HOA, utilities, auto insurance, gas and auto maintenance, groceries, prescriptions, travel, clothing, gifts, etc. Itemize every expense you have as best you can. All of these expenses together make up your cost of living and are a crucial factor in determining if you can afford to retire. Let's look at the sources of retirement income. Social Security. You must have Social Security as a source or you would not be watching this tutorial. Do you have a pension? Will it continue or be reduced for your spouse if you pass away? You need to factor your answer into your financial plan. Perhaps you plan to work a little in retirement in a job you will enjoy. Working is healthy exercise. Retirement accounts. Do you have a retirement account? 401k, 403b, IRA? Possibly you have rental properties or investments that pay a steady stream of dividends or annuity payments. Whatever your resources are, you need to identify them and understand how reliable they are, and are they enough to sustain your livelihood for decades to come, no matter what happens. What role does Social Security have in your retirement plan? Is it a primary source of income or a supplemental source of income? Let's get into the specifics of Social Security. It begins with your full retirement age, which is determined by the year you were born. Identify your year of birth in the first column and the corresponding full retirement age. Your full retirement age determines what month you are eligible to begin receiving your Social Security benefit. If you look at our sample statements, you see the first statement reflects a benefit of $878 a month at this person's full retirement age. The second sample shows this person would receive $2,944 at their full retirement age. Everyone's benefit is based on their lifetime of earnings and contributions to their Social Security fund. Age-based benefit adjustments. We just addressed the full retirement age and the respective benefit at that age. However, Social Security allows you to begin your benefits as early as age 62 at a reduced rate, or you can opt to delay filing for your benefits and increase your benefit by 8% per full year up to your 70th birthday. The adjustments in this table are illustrating what the percentage would be if the person filed on their birthday. However, the calculations are done on a monthly basis and are different for each month between age 62 and 70. You can see the exact formula in the box on the right. Let's look at someone born in 1957 with a full retirement age of 66 plus 6 months. We see that if they filed on their 66th birthday, they would receive only 97% of their full retirement age benefit because they actually are filing 6 months early. Conversely, if they waited and filed on their 67th birthday, they would receive 104% of their full retirement age benefit because they delayed their filing for 6 months past their full retirement age. Note the blank cells represent ages that have already passed for someone born in their respective year, and a person born in 1954 would already be 67 and entitled to 108% of their full retirement age benefit if they have not filed as of yet. Social Security benefit calculations. Have you ever wondered how they calculated my benefits? Social Security calculates your benefits based on the sum of your earnings for your 35 highest paid years and produces an averaged index monthly earnings, AIM. The AIM is used to calculate your primary insurance amount or the benefit you will receive at your full retirement age. They use what is referred to as the bend point formula. Sum of the highest 35 years divided by the 420 months, that equals your AIM. Let's look at the bend point formula. In this example, the person earned $3.5 million in their highest 35 years, and their AIM is $8,333. They will receive 90% on the first $996 of their AIM, depositing $896 into their benefit. Everything over $996 and under $6,002, they earn 32% on. In this example, the person gets an additional $1,602 deposited into their benefit. They earn 15% of everything over $6,002. In this case, the person gets an additional $350 added to their benefit. This person's primary insurance amount, the sum of all their totals, is $2,848, which is what they will receive per month if they file at their full retirement age. Their annualized benefit is $34,176. The next subject, we're going to look at spousal benefits. For married couples, they must have been married for at least 1 year, and the worker must file for the spouse to be eligible for spousal benefits. The spousal benefit is based on the worker's full retirement age benefit, and the percentage the spouse will receive depends on the spouse's age when they file. The maximum benefit is 50% at age 66 and beyond. Divorced couples follow a different set of rules. They must have been married for no less than 10 years, and their divorce must have been finalized for at least 2 years. In this example, the worker does not need to file, however, the worker must be at least 62. The rest of the rules are the same as married couples. If your ex-spouse dies at some point after you have filed for spousal benefits and you are not presently married, you are now eligible for survivor's benefits, which we will discuss next. Also, if you have more than one ex-spouse and each marriage lasted for at least 10 years, and you have been divorced for at least 2 years from your last ex, then your spousal benefit is based on the highest ex-spouse's full retirement age benefit. Survivor benefits work similarly to spousal benefits in that they are based on the deceased spouse's full retirement age benefit if they pass away prior to their full retirement age. The percentage that the surviving spouse receives is based on how old the survivor is when they file. The earliest a survivor can file for benefits is age 60, age 50 if you are disabled, and the survivor benefit percentage does not grow any larger than the 100% they would receive at age 66, though the deceased spouse's benefit value does increase after their full retirement age by 8% per year up to their 70th birthday if a survivor benefit has not been exercised. You must be married to a current spouse for at least 9 months to be eligible for their survivor benefits. If you have a qualified divorce, as discussed previously, and your ex has since died and your current spouse dies, you are now eligible for the highest survivor benefit of the two, provided you meet the criteria outlined. Note that survivor benefits are subject to the earnings test that we will discuss a little later. Strategies to consider. Depending on your financial needs and your own benefit value, know that you can file for survivor benefits now and allow your own benefits to continue to grow at the 8% per year up to age 70. Then switch to your own benefit if it has a higher value. You can do just the opposite as well. File for your own smaller benefit now and let your survivor benefit grow up until your deceased spouse's 70th birthday, when it will have reached its maximum value. For you, it's important to know, file no earlier than your own 66th birthday to receive 100% of your deceased spouse's benefit. Age-based benefit modifications. To best illustrate the effect filing for benefits at various ages, let's use a scenario of triplets. All 3 children were born on the same day in the same year and worked for their father directly out of college. Their father paid them exactly the same amount every year for all of their career. Dad sells the business when they were 62 and they were all retired. Their full retirement age benefit is identical at $2,000 at age 66, and their reduced benefit at age 62 is $1,500. Their benefit at age 70 would be $2,640. Brother number 1 decides he is going to file at age 62 and receive $1,500 per month. The sister married very well to a man her age. She and her husband decide they will wait until they both turn 66 to file, when he will also retire. The other brother never married and has no children and does not need the money, so he decides to delay filing until age 70 to get the larger check. At age 62, the first brother begins to receive his benefits of $1,500 a month. But let's travel through time. Their 66th birthday is approaching, and the sister and her husband are in a serious car accident and both die. What happens to their Social Security benefits? It's dissolved, assuming they have no dependent children. Traveling through time further, the 70th birthday is approaching, but the third sibling brother has a heart attack weeks before, and unfortunately he dies. His benefits? They are dissolved as well. This story is told for effect. Social Security does not have a death benefit aside from survivor benefits, as we discussed earlier. Know that everyone does not die of old age. On this slide, we're going to go back to our story but change the outcome. Nobody dies. We see brother number 1 receiving his benefits at age 62 annualized to $18,000. The sister will receive $24,000 annualized at age 66, and the other brother will receive $31,680 at age 70. At age 66, brother number 1 has received $74,189 before either sibling has received a dime. At age 70, he's received $154,493 more than his brother, and his sister has received $73,949 more than the other brother. When do they break even? We see the sister catches up with brother number 1 at age 84, and brother number 2 passes him at age 82, and passes his sister at age 81. On the surface, it appears that the break-even is approximately the early 80s, However, we are overlooking a very important factor. In this scenario, what did the sister and brother number 2 do to sustain their livelihood during their deferment period? Certainly they spent money. Assuming they only spent the equivalency of brother number 1's $18,000 compounded at 2% for inflation, they are negative the highlighted figures at ages 65 and 69. So it's not when did they break even, but when did they get their money back? If we look at the bottom of the table, we see it is in their early 90s. Considerations: job, health, longevity, finances. You can use this illustration to contemplate your own situation. However, it's important to recognize that in this scenario, all parties retired at age 62. If the sister or brother number 2 had worked in some capacity earning at least the $18,000 figure while deferring their Social Security benefits, the analysis would be completely different. It all comes down to one thing. If you knew when you were going to die, you could calculate the perfect strategy for filing. Can you work and still receive Social Security benefits? Yes, however, there is a limit to how much you can earn each year. In 2021, the maximum you can earn is $18,960 without affecting your benefits. Every dollar over that limit reduces your benefit by 50 cents. Social Security likes to describe it as $1 for every $2 in excess of the exempt amount. In this example, the person's gross income is $63,960. Minus the exempt amount of $18,960 creates an adjusted earnings of $45,000. 50 cents per dollar reduces their Social Security benefit by $22,500. This person would only receive $1,500 this year due to their earned income. Know that Social Security only cares about you, the individual, not your spouse. Your spouse can make as much as they want, and it will not affect your Social Security benefit. What happens when I reach full retirement age? Benefits are reduced $1 for every $3 of earnings in excess of the exempt amount, and the exempt amount is $50,520. In this example, the person's gross income is $63,960 minus the exempt amount of $50,520, creating an adjusted earnings of $13,440. 33 cents per dollar reduces their Social Security benefit by $4,480. This person would receive $19,520 this year due to their earned income. Note this rule only applies to months leading up to your actual full retirement age, so if your full retirement age is May, then only your earnings January through April would apply to this formula. After May, you can earn an unlimited amount and not affect your benefits. What income counts in the earnings test? Basically, it is your earned income, W-2 and or a 1099 from self-employment or contracting. Alimony also counts, and contributions to a retirement plan counts. Don't think you're going to outsmart the Social Security Administration by contributing to your 401k. That contribution is considered tax deferred by the IRS, but not the Social Security Administration. Will my benefits be taxed? Officially, Social Security is tax-free unless your household income earns taxable income above a certain level. Remember when we said the Social Security Administration only cares about the individual, not the spouse? The IRS has a different outlook. The IRS looks at the household income and includes 50% of your household Social Security benefits. There are two sets of tables here, and each one has two tables within it. The top one is for married filing jointly, and the bottom one for individual filers. Let's look at the married table first. The left side of the table shows how the IRS determines how much of your Social Security benefit is subject to taxes. We see on the right side that the household received $20,000 in Social Security benefits. Back to the left, we see $60,000 income representing $50,000 from employment plus 50% of the Social Security benefits. That figure is more than $44,000. So that means that 85% of their Social Security benefit is subject to taxes. 85% of $20,000 is $17,000. Times 15% tax is $2,550 for a net of $17,450. The single filer has the same concept. This individual received $12,000 in benefits times 50% is $6,000. Add that to their income of $24,000 for a total income of $30,000. $30,000 falls into the middle category, so only 50% of their benefit is subject to taxes. 12,000 times 50% is 6,000 times 12% tax. This individual would pay $720 in taxes for a net benefit of $11,280. Don't dwell on the taxes, focus on the net benefit. Rarely does it make sense to delay benefits because you have to pay taxes on them. Remember what happened to the sister? The Windfall Elimination provision, known as WEP, applies to you if you are receiving a government pension and are also claiming your own Social Security benefits. This calculation is hard to explain when you don't have all the factors, but this will give you a trick to do the math backwards. First, you must open your statement and identify your earnings by year. Then, referring to the threshold of substantial earnings, you must count how many years you exceeded the threshold. Match the number of years counted to the years of substantial earnings to identify the corresponding percentage that applies to you. The table on the right is the AIM table from earlier. You will recall that 90% of the first $996 resulted in $896 towards your benefit. You need to multiply your new percentage by $996 and subtract that answer from $896 to see the reduction you will receive. If your full retirement age benefit is lower than the $896, use your benefit value in its place. The maximum reduction in 2020 was $480 and is limited to no more than 50% of your pension from non-covered employment. The government pension offset. This applies to you if you're receiving a government pension and plan to file for a spousal or survivor Social Security benefit. This is the most painful adjustment to benefits. Your Social Security benefit is reduced by 2/3 of your government pension amount. In this example, the person's government pension is $2,100 per month and their spousal survivor benefit is $1,500. The government pension offset reduces their Social Security benefit by $1,400, bringing their Social Security benefit to $100. If this applies to you, calculate taking your own lower Social Security benefit with the WEP reduction and compare that benefit to the spousal survivor benefit with the 2/3 GPO reduction. Now that we have reviewed Social Security's rules and various strategies, how will you fit it into your retirement plan? Will you work longer or retire sooner? Will you file now or later? Perhaps take advantage of a spousal benefit. Whatever you decide, you need a retirement plan so there is no surprises along the way. Retirement is the longest vacation you will ever take. Every day is Saturday. Do you have a plan? The road ahead. We hope our retirement will be a Sunday drive, but Sunday drives aren't always pleasant. You don't know what's around the next corner or what tomorrow will bring. Expect the unexpected. Let's look at inflation. Do you know what it costs to operate your household? If you spent $25,000 in 2020 to operate your household, you will spend $33,500 in 10 years and $45,100 in 20 years. You will not be buying more. You will just be paying more for the same amount of goods and services, assuming a 3% cost of living adjustment. This does not include new purchases, autos, retirement, travel, new medical needs and prescriptions that are not covered by insurance, long-term care. Be prepared and factor in unexpected costs when you're creating your financial plan. Healthcare expenses. Medicare is not free. The standard premium is $148 per month. Supplemental health insurance, the average policy is $125 to $150 per month. Unforeseen medical care and prescriptions. Assisted living, $50,000. Nursing home, the average cost in the United States is over $100,000. Protect your portfolio. If you are depending on your portfolio to provide financial support during your retirement, make sure you invest wisely. Look for sound and prudent conservative investments. Market corrections can cripple a portfolio overnight. Your needed supplement income can have catastrophic effects on your portfolio if you are forced to take a regular withdrawal to meet your needs following a market correction. And market corrections happen all the time, and sometimes last for years. Do you have a financial plan for your retirement? Or are you just going to wing it? This is the typical retirement plan. If it's any comfort, you're not alone. If you do not have a retirement plan in place, we invite you to take a look at our low-cost, do-it-yourself financial planning software, LivingLedger. The software will allow you to inventory your household expenses and identify your annual income by source. You can create your own comprehensive financial plan that you control. You will see your cash flow item by item, year by year for decades. You will see your portfolio and how it is being utilized each year to supplement your income throughout retirement. You will see your future balances projected way in advance and feel comfortable you are on track to go the distance, or have an opportunity to make adjustments in advance to avert a shortfall. We encourage you to invest a little in your future to assure your retirement years are truly golden. Thank you for watching our Social Security tutorial. Visit our website and video library on more subjects to guide you into and through retirement.